My dear students, today we have to learn the two important concepts for second semester MCOM module 2, the second chapter RBI. The two concepts are statutory liquidity ratio and cash reserve ratio. These are the two concepts. After that, let us proceed to banking system and banks in India as per the curriculum of second semester MCOM. Now, let's understand what is this SLR, Statutory Liquidity Ratio. What do you mean by that? Let us try to understand the first concept. Banks are required to invest a certain percentage of their time and demand deposits in assets specified by RBI, including gold and government bonds and securities. In monetary system, SLR is that percentage of net demand and time liabilities, which we abbreviate as NDTL. In other words, bank deposits that must be used to buy the specified assets. The SLR ratio has been in the range of 23 to 25% for the past 10 years. The current SLR ratio of 22.5%, which means that for every rupees 100 deposited in a bank, it has to invest 22 rupees 50 paisa in any of the asset classes approved by RBI. Banks usually keep more than the required SLR, and at present the actual SLR stands at 29%. The RBI wants banks to hold a part of the money in near cash so that they can meet any unexpected demand from the depositors at short notice by selling the bonds. In India, historically, banks' SLR has been high as they need to bear the burden of the government fiscal deficit. The government borrows from the bank every year to bridge the fiscal deficit. A cut in SLR indicates that RBI is confident of the government's commitment to fiscal consolidation. Now let us proceed to the second concept, that is cash reserve ratio, that is CRR. Cash reserve ratio is a portion of the bank's NDTL or deposits that need to be kept in their specified current accounts maintained with RBI. This money earns no interest. The current CRR level is 4%. This means that for every rupees 100 of the deposit that the bank holds, it keeps aside rupees 4 with RBI. CRR, which is maintained on a fortnightly basis, a tool that the central bank uses to manage money supply and liquidity in the market. Generally, it is increased to reduce the outstanding liability in banking system. RBI reduces CRR if it needs to increase the money supply in the economy. See, that is about the two important concepts which are to be studied under the second module of RBI, that is statutory liquidity ratio and cash reserve ratio. Now let us go to the next important subtopic, that is banking system and banks in India. This can be studied under the five important headings. First one is RBI, Reserve Bank of India. Second one is commercial banks. Under commercial banks, there are different four types of the banks, that is public sector banks, private sector banks, foreign banks, and regional rural banks, which we call it as RRBs. So, second important thing is that. Coming to the third important type of the banks in India is cooperative banks. Under cooperative banks, you have state cooperative banks, central cooperative banks, and primary cooperative banks. So the fourth category is scheduled and non-scheduled banks. So let us try to understand this later. So fifth important thing is development banks and other financial institutions. Let us take up one by one in detail. The first important thing is RBI. The Reserve Bank of India is the central bank of our country. It was established on 1st April 1935 under the RBI Act of 1934. It holds the apex position in the banking structure. RBI performs various developmental and promotional functions. It has given wide powers to supervise and control the banking structure. It occupies the pivotal position in the monetary and banking structure of the country. In many countries, central bank is known by different names. For example, Federal Reserve Bank of USA, Bank of England in UK, and Reserve Bank of India in India. Central bank is known as a banker's bank. They have the authority to formulate and implement monetary and credit policies. It is owned by government of a country and it has the monopoly power of issuing the notes. See, that's all about the RBI part. See, coming to the commercial banks. Commercial banks is an institution that accepts the deposits, makes business loans and other related services to various like accepting deposits and lending loans and advances to the general customers and businessmen. These institutions run to make profit. They cater to the financial requirements of industries and various sectors like agriculture, rural development, etc. It is a profit-making institution owned by government or private or by both. Commercial bank includes public sector, private sector, foreign sector and regional rural banks. See, let us try to understand what is the exact meaning of public sector banks. It includes SBI, 7 associate banks and 19 nationalized banks. Altogether, there are 27 public sector banks. The public sector accounts for 90% of the total banking business in India, and State Bank of India is the largest commercial bank in terms of volume of all commercial banks. That's all about the public sector banks. Now, let us try to understand what does this private sector banks exactly mean. Private sector banks are those whose equity is held by private shareholders. For example, ICICI, HDFC, etc. Private sector bank plays a major role in the development of Indian banking industry. Now let us proceed to the third important one, foreign banks. What does it mean? See here, foreign banks are those banks which have their head office abroad. CITI Bank, HSBC, Standard Charter, etc. are the examples of foreign bank in India. Now let us proceed to the next important type of commercial bank, regional rural banks, which are actually called as RRBs. These are the state-sponsored regional rural oriented banks. They provide credit for agriculture and rural development. The main objective of RRB is to develop rural economy. Their borrowers include small and marginal farmers, agricultural laborers, artisans, etc. NABARD holds the apex position in the agricultural and rural development. Now, let us proceed to the third important type of the bank, which is cooperative bank. Cooperative banks was set up by passing a Cooperative Act in 1904. They are organized and managed on a principle of cooperation and mutual help. The main objective of cooperative bank is to provide rural credit. The cooperative banks in India play an important role even today in rural cooperative financing. The enactment of Cooperative Credit Societies Act in 1904, however, gave the real impetus to the movement. The Cooperative Credit Societies Act of 1904 was amended in 1912 with a view to broad basing to enable the organization of non-credit societies. There are three important structures exist in cooperative banking. There are three important. One is state cooperative bank, second one is central cooperative bank, and third one is primary cooperative bank. Now let us proceed to the fourth important type of our banks in India, scheduled and non-scheduled banks. A bank is said to be a scheduled bank when it has a paid up capital and reserves as per the prescription of RBI and included in the second schedule of RBI Act of 1934. Please understand. See here, scheduled banks are those banks which own or which has a paid up capital and reserves as per the prescription of RBI and included in the second schedule of RBI Act 1934. Non-scheduled bank are those commercial banks which are not included in the second schedule of RBI Act 1934. Say any bank which is included under the second schedule of RBI Act of 1934 is called a scheduled bank, and any bank which is not included under the second schedule of RBI Act of 1934 is called as non-scheduled bank. Last but not the least, let us go to the development banks and other financial institutions. A development bank is a financial institution which provides a long-term funds to the industries for development purpose. This organization includes banks like IDBI, ICICI, IFCI, etc. State level institutions like SFCs, SIDCs. It has also includes investment institutions like UTI, LIC and GIC, etc. See, today we have learnt two important concepts according to our syllabus: statutory liquidity ratio, which is actually known as SLR, and cash reserve ratio, which is called as CRR. And afterwards we learnt what is the banking system and banks in India. We have bifurcated into 5 types. Again, commercial banks are bifurcated into 4 types and cooperative banks are bifurcated into 3 types. After that, we also learnt the scheduled and non-scheduled banks. After that, last but not the least, we learned the development banks and other financial institutions. Thank you. See, this is the end of our second module.